Hey guys, Dave Keller here with Market Misbehavior. Today we're going to talk about what I consider the most important chart for bulls right now. This is an indicator, a breadth indicator looking at the percent of stocks in the S&P 500 that are trading above their 50-day moving averages. We recorded a previous video about the importance of the 50-day moving average. We'll have a link in the description below. Today we're going to talk about how we roll that up into a breadth indicator, what it's telling us right now about potentially limited upside for stocks and potentially a breakdown alert for the markets as a whole, but especially for individual stocks, what that means for individual names you might be looking at. So today we're going to talk about the most important chart for bulls. So we recorded a previous video talking about the 50-day moving average. We had a lot of great questions and feedback on that video where we focused on why investors, why technical analysts like to smooth out price data using moving averages. And we looked at some examples using the 50-day. It's one of the most commonly used indicators, moving averages out there. The 50 and 200-day are by far the most common because they give you a sense of the short-term and long-term trends, smooth out the price movement, get rid of the noise. Before we get to a breadth indicator driven by the 50-day moving average, I just want to mention if you appreciate this sort of discussion about market dynamics, investor psychology, charts, technical analysis, all of the above, I'd love if you'd subscribe to the channel. It'd be great to have you along this ride with us. Also, give us a thumbs up if you appreciate the video. We would very much appreciate that right back. Finally, I'd be very interested to know what you think about the overall market. Do you think the next 10% move in the S&P is higher or lower? Put a comment below the video and let me know what you think. Now let's get to today's chart. So the 50-day moving average is a commonly used technique, and I don't want to describe everything that we covered in a previous video on the channel. I'd encourage you to check that out if you want to learn more about the 50-day moving average. But this chart of the spiders for the last year shows you why so many investors rely on the 50-day for actionable pullbacks within a long-term uptrend. When a market is in an uptrend, it doesn't just go straight up or have a consistent trend. It sort of has fits and starts, right? There are impulse moves and corrective moves, as an Elliott wave fan might describe it, where you have a move in the direction of the overall trend and then a pullback that moves contrary to the trend. And overall, even though the trend longer term is positive, you have these short-term tactical upswings and downswings. And overall, this nets out to a positive trend in the stock or in the ETF. If you look at the spiders, if you start in 2021, you can see a number of times where the S&P is pulled down to it's an ascending 50-day moving average. Every one of those times, it's traded right back out. Sometimes it's traded below it, but not closed below it, or closed right on it like you did there in January. Sometimes it's closed below it, but has not followed through the next day. A lot of times in my work, we talk about follow through or confirmation days. So if you have a breakdown of support, you want confirmation from the next day, some sort of indication that that was not a fluke, that there is an evaporation of demand or selling pressure that's coming in that's pushing price lower. You can see a number of times when we've hit the 50-day moving average, the next day has been an up day, right? An up close, as a lot of investors, again, are assuming that you'll find support there. And if enough of us assume support and we put in enough buy orders expecting it, we will potentially, it's a self-fulfilling prophecy, we'll provide the support that we think the chart may be anticipating. We're recording this here on Tuesday, June 22nd of 2021, and you can see Friday's close, which is a bit of distribution after the Fed meeting last Wednesday. You can see the close below the 50-day for the second time this year. And then you can see Monday, very quickly, we bounced right back off. And then we're following through so far today, pushing through, continuing to the upside, threatening new all-time highs for the S&P. So this is why the 50-day ends up being so important. You'll also notice why September, October, November was a very different period from what we've seen in 2021, because we broke clearly through the 50-day moving average, which means you have to think a lot more about potential risk. You have to think about downside protection, think about taking some of your offense off the field, because there's, again, while it's maybe unlikely that we have a climactic negative trend again, it's certainly a possibility. It's a non-zero risk, as I like to tell my clients, right? And again, not that you can assume that that's going to happen, but you better be emotionally and positionally prepared for that potential future path, and have a good game plan in mind for if and when things would continue to deteriorate. Now, what's interesting is if we look at the members of the S&P 500, well, the S&P has bounced off of its 50-day a number of times. And now we're looking at the last 2 years. You can see at the top here, this is the S&P index. You can see very similar, obviously, to the SPYs that we've bounced off of the lows bounced off of the 50-day a number of times. If you look down a little bit, you can see the percent of stocks above their 200-day moving average, which is the red line here. The S&P has not touched its 200 days since last summer. It's been pretty far away from it for most of this uptrend because of the strength of the up move. So currently it's around 90% of S&P members above their 200-day. And that sounds about right. I mean, try to come up with a chart off the top of your head that is in a downtrend below its 200-day moving average. Probably kind of hard to do because there aren't many of them. There's only 10%. 1 out of every 10 in the S&P is below its 200-day right now. It's not many. This bottom series is the one we're going to pay attention to. This is the percent of S&P stocks currently above their 50-day moving average. You can see back here in April, which is when the S&P was making another new all-time high, and really for much of this year, it's essentially made a new all-time high every month. Every month we get a new high in the S&P. If you look down here, though, in the last couple months, it's actually this indicator has sloped downward. So as the S&P has made higher highs, this indicator is actually making lower highs, which tells you every time the S&P now is pushing higher, less and less stocks are actually getting back above their 50-day moving average. More and more stocks are actually breaking below their 50-day. And let's look at it in particular. Here in April, you had about 92% of the S&P above their 50-day moving average. This is when the S&P was making a new all-time high the second week in April. Look at where that number is just this week. It's actually down around 32%. So what happened is over the last 2 months, basically, as the S&P has made a new all-time high in May, and then again, testing that same level in June, about 60% of the S&P members have gone from above their 50-day moving average in mid-April to below their 50-day moving average in mid-June. Now, again, in the last day or two, that's bounced up. And as of Tuesday's close, depending on where the market closed, it might be around 45, 50% of stocks above their 50-day moving average. But again, that's a far cry from where things were in April. So think about what that means. While the S&P has held its 50-day and has bounced off of it a number of times, many stocks have actually closed back below their 50-day moving average and have not regained that. Now, what are those? Those are things like energy and financials, a lot of the value-oriented, the cyclical sectors that had done so well toward the beginning of the year, but all started to come off a little bit as rates sort of stopped their acceleration to the upside, came off a little bit, and the growth stocks like Apple and Facebook are rotating back to the upside, breaking out of their congestion patterns, breaking to new highs, and indicating a renewed strength for the growth trade. And a lot of those stocks that were above their 50-day and now we're back below are in those cyclical sectors, I would assume. Not looking at every single one of them, but based on the charts I'm looking at, that sounds about right. So why is this such an important indicator right now? We'll look back over the last year and look at what happened when this indicator remained above 50% and when it broke below it. A number of times in the last year, it's hit the 50% line and then bounced right back up. And most recently, we had June, July of 2020. We'll come back to last fall. In January of 2021, in March of 2021, one of those times the S&P hit its 50-day, this indicator came down to about 50%. It very quickly turned back to the upside and bounced higher and indicated a fairly resilient uptrend, right? The market moving higher, a lot of stocks coming off, but not so many that the indicator is going below 50%. Now look at how that was different in September of 2020, in October of 2020, in February of 2020. Each one of those times, this indicator went below 50%, and that was met with more of a price and or time correction. The correction in February to March of 2020 was more of a price correction, right? Did not take much time, about a month before all was said and done, but that was a quick acceleration to the downside, giving up so much of the previous gains. But it was a month, and all of a sudden you lost all of that value. If you look at September and October of 2020, it was more of a time correction, right? We didn't really lose a lot in terms of price, but we lost plenty in terms of time. It took about 2.5 months for the S&P to regain the highs from early September and then continue on to new highs in November and into December of last year. So overall, this indicator remaining above 50% is often what can help you determine whether or not this is a buyable pullback, a short-term pullback within a longer-term uptrend, or whether it's something deeper in terms of time and or price. And again, the reason why that's such an important indicator is because it tells you not just what the S&P is doing, but all the 500 stocks that comprise the S&P 500. What are they doing? Are they holding their 50-day moving average? And a lot of times at a major top, the indicator will break down, and that will confirm the fact that that the index is just not going to have enough buying power to continue to push to new highs. Now, what does that mean in terms of individual stocks you're looking at. Now, a lot of institutional investors will use the 50-day moving average as a tactical buy point, as a tactical pullback opportunity. Some will use a weekly chart and do a 10-week moving average, which is about the same as a 50-day moving average, obviously. So IBM is maybe a perfect example of a stock that, if things are good, if I'm bullish and I'm just expecting this recent sell-off to be an actionable pullback, a tactical pullback within a cyclical uptrend, then charts like IBM should most likely hold their 50-day moving average. And you can see on Friday's close, it traded down almost to the penny to its 50-day moving average. So far this week has bounced higher. And that's what you would expect to see in just a normal plain vanilla environment. If this holds, and if the 50-day holds, that tells you, just as we've seen a number of times on many, many charts going back over history during cyclical uptrends, this is a buyable pullback and all is well, and we ride the next leg of IBM higher. But if this sort of chart of stocks like IBM and others like it fail at their 50-day, they bounce off of there and form more of what's called a dead cat bounce, which is a big move to the downside, a quick move back to the upside before the next leg lower. So a number of people kind of get sucked in. You call this a bear trap, where it's a downtrend, a quick uptrend that sucks some people in, but in the end, it's actually really more of an initial rally before the next leg lower. Stocks like IBM would need to break their 50-day moving average. If that happens, that would be a quick or a significant indication of further downside potential. And I think you'd see a lot of stocks accelerate to the downside as we enter a period of distribution. As people recognize 50-day moving averages are not holding, then they tend to pay a lot more attention about risk and think about downside, think about capital preservation, and make sure that you take profits before you lose much more. And enough of that happens and the price starts to accelerate to the downside. Now, I mentioned some of the stocks that have not held their 50-day moving average. You can find plenty of them in the cyclical sectors. We're looking here at a financial stock, Fifth Third Bank. This is one of the regional banks. Most of them have broken down through their 50-day moving averages by now. So while IBM and more of a growth sector has held its 50-day, a stock like Fifth Third Bank has already broken down through its 50-day moving average. But here's where it gets really interesting. On the chart of Fifth Third, what would you be looking for? It's whether it's able to hold its previous support. Because a lot of times a breakdown of the 50-day doesn't tell you that the stock's going to go to zero. And a lot of times we think of the markets as a binary outcome, right? Are you bullish or bearish? Is this going up or going down? And what you have to remember is, if you look at the chart of the S&P over the last couple of months, it's really not been going up or down. It's been more sideways, right? You accelerated into the high in April, and then we've really been more of in a consolidation range as it's been more rotational, right? Things have been working, things are not. You'll find the value sectors work one day and then they don't. You'll find the growth sectors at the bottom and then they're at the positive. They're on the top of the list the next day. So it's been more choppy, rotational around these different things. So while Fifth Third Bank is no longer going up, I would argue it's not really going down yet. It's just not going higher, right? It made a new all-time high last month, but this month has not made a new high, right? It's actually made a lower peak and has broken down through its 50-day moving average. The question on this, the line in the sand on something like Fifth Third Bank for me would be more like 36. Can it hold that low from late March, from mid-April? If that breaks, so if IBM breaks its 50-day, if something like Fifth Third is unable to hold 36, that would very quickly signal a broad deterioration where stocks are not holding moving average support. They're not holding price support. There is broader selling pressure than what we've seen so far. And all of a sudden, this quickly looks, changes appearance, sort of a change of character from a bullish environment of buyable pullbacks on the way up to more of a distributive environment, more of a bearish environment where stocks are not able to hold support. They're breaking down through key levels and then following through to the downside. So this breadth indicator, looking at stocks above their 50-day moving average, I would argue, if you're bullish, will be one of the most important charts to watch. Do we stay below the 50% level, which tells you that there's deterioration happening? So far, it looks a lot more like the price and time corrections than it does the buyable pullback sort of patterns, because we've gone pretty far, almost hit 30% of stocks above their 50-day. However, for that to actually materialize and for that bearish trend to continue, you would need to see, or you would expect to see, stocks like IBM fail at their 50-day, stocks like Fifth Third Bank remain below their 50-day, and also start to break price support. So that's it. This is just a quick recap on why and how we use the 50-day moving average on individual charts, why the charts of IBM and Fifth Third and other stocks like it are at pretty key moments right here. But more importantly, how we can roll that up into a breadth indicator. Look at how many stocks within the S&P are remaining above their 50-day moving average. Again, what I've seen going into Friday's close really started to make me think less about upside potential for stocks and more about downside potential, or the prospect for further deterioration in time and or price. What that might mean for stocks that you're holding, ETFs that you're holding, what lines in the sand, like the level we reiterated for Fifth Third Bank, like what levels would you pay attention to that would at the very least signal that you should go back and review that position and see if it still makes sense. If this sort of thinking about market dynamics, market history, investor psychology, charts, and technical analysis is of interest to you, I hope you'll subscribe to my channel. It'd be awesome to have you along this ride with us. Also, give the video a like if you appreciated it. We would very much appreciate that back. Finally, put a comment below the video today. What do you think is the future path for the S&P 500? The next 10% move, higher or lower, and why? Let me know in the comments below. From everyone here at Market Misbehavior, I'm Dave Keller. Be safe, be well. We'll talk to you again soon.